Hi everyone, my name is Matt Richardson from Taylor Partners, and today in the second of our series we're going to talk to you about the changes to transition to retirement income streams. Now because that's a mouthful, I'm going to use the acronym TRIS because that's easier to say. So a TRIS, what is a TRIS? A TRIS is an income stream you can commence from a superannuation fund where you are of what's called preservation age, which means you have to be at least age 56 at present. And you're still gainfully employed in some way. So you haven't retired, and it means you can access between 4% and a maximum of 10% of your account balance. Now what's happening, there's two taxing points in relation to a TRIS. The first one is the taxation treatment on what you withdraw from the fund and the taxation treatment of the earnings within the fund. Now there hasn't been any change at all to the taxation treatment of what you withdraw from the fund. If you're under 60 years of age, there will be some tax impact on what you withdraw. If you're 60 years or over, there'll be absolutely no change. So what we're talking about today is changes to the taxation treatment on the earnings inside the fund. So what's happening is, in the current year, any earnings within a self-managed superannuation fund on a TRIS are exempt from income tax. From the 1st of July 2017, you can still withdraw money from a TRIS account, and there's nothing stopping you from doing that, but the taxation treatment within the fund will change. So the ways you can address that are, instead of it being a TRIS account, you must be able to convert it to what's called an account-based pension. And the only way you can convert it from a TRIS to an account-based pension is to satisfy what's called a condition of release. There's three available conditions of release which are generally accepted by the ATO. The first one is if you are at least preservation age, so age 56 and retired, and retirement means you basically make a declaration that you have no intention of being gainfully employed in the future. The second one is you reach age 65 regardless of your work status, because once you reach age 65 you have satisfied a condition of release and all of your superannuation becomes accessible and it turns into an account-based pension immediately. The third option, and probably the least known or the least option that's been taken advantage of, is once you turn age 60, if you have one arrangement by which you are gainfully employed and that ceases, well then you've satisfied a condition of release and you're able to access your funds under an account-based pension. Now that may mean you've got two jobs, one might be part-time, one might be a casual job. Providing you satisfy the gainful employment test and you've worked at least 40 hours in a 30-day period with that employment, if that ceases, well then you have satisfied a condition of release. Your pension account then goes from a TRIS account to an account-based pension account, and the earnings on that account in the self-managed super fund would now be exempt from tax. So if you want to learn more about how the changes to TRIS accounts will affect you, please come and see us at Taylor Partners.